while being slightly fast-paced. The U.S. stock market is currently open. Opendoor Technologies, Inc., OPN, is trading on a NASDAQ at $9.72, down approximately 2.20% for the day as of 9:57 a.m. Eastern Time on Friday, September 19, 2025. You're watching Opendoor Technologies, ticker OPN, and you see a stock that's been on a seemingly unstoppable tear, a darling of the prop-tech revolution that promises to streamline the archaic process of buying and selling a home. The expectation is one of explosive growth, of a disruptive force completely upending a trillion-dollar industry. But the reality of this moment, reflected in today's downward pressure on the stock, hints at a far more complex and perilous narrative, one that the breathless headlines often overlook. The common belief is that Opendoor's iBuying model is an elegant, tech-driven solution for a new generation of homeowners. The deeper reality, however, is that this model is incredibly capital-intensive, exquisitely sensitive to the violent swings of the housing market, and now faces a crucible moment with a new leadership team at the helm. Investors in platforms like Fidelity, Schwab Intelligent Portfolios, and SoFi Invest are trying to decipher if this is a revolutionary invest online opportunity or a cyclical trap. The recent price action of Opendoor stock has been nothing short of dramatic. Just days ago, the stock was hitting fresh 52-week highs, cresting over $10.70. This surge wasn't just a blip. It was the culmination of a staggering 650% run over the past 6 months, a rally that has forced even the most ardent bears to reconsider their positions. This meteoric rise was fueled by a potent cocktail of factors: a broader market rotation into growth-oriented tech stocks, renewed optimism about the real estate market, and, most significantly, a major leadership shakeup. The announcement that CEO Carrie Wheeler would step down to be replaced by former Shopify executive Srisha Radhakrishna sent a jolt of electricity through the market. The expectation was clear: a new dynamic leader would bring a fresh perspective and a founder-mode mentality, aiming to slash costs and steer the perpetually unprofitable company toward the black. Founders Keith Rabois and Eric Wu returning to the board further solidified this narrative of a company getting back to its aggressive, innovative roots. This is the kind of story that gets retail traders on Robinhood and users of the Fidelity mobile app excited, driving significant volume and volatility. However, the reality of Opendoor's financial situation presents a stark contrast to this bullish narrative. While the company has demonstrated an impressive ability to generate revenue, its gross profit margins remain razor-thin, hovering around 8%. This is the fundamental challenge of the iBuying model. You are essentially a high-volume, low-margin home flipper, operating at a massive scale. The spread between the price at which Opendoor buys a home and the price at which it sells it is the company's lifeblood, and that spread is under constant threat from market fluctuations, repair costs, and holding expenses. In its most recent quarter, the company posted revenue of $1.6 billion, but a gross profit of only $128 million. After accounting for marketing, overhead, product development, and significant interest expenses, Opendoor remained, as it has for its entire public life, unprofitable. The recent surge in stock price has pushed its market capitalization to over $7 billion, creating sky-high expectations for a company that has yet to demonstrate a sustainable path to profitability. This is a critical point for anyone managing a self-investing portfolio or utilizing investment help from platforms like Interactive Brokers. The valuation appears to be pricing in a perfect execution of a turnaround that is far from guaranteed. To understand the immense challenge facing Opendoor, one must grasp the core of its business. The company operates as an iBuyer, instant buyer. It uses sophisticated algorithms to make all-cash offers on homes, promising sellers speed and convenience over the traditional, often cumbersome selling process. Once purchased, Opendoor makes necessary repairs and then lists the home for sale on the open market. This model thrives in a stable or rising housing market where home price appreciation can buffer its slim margins. However, in a market characterized by high mortgage rates and decelerating price growth, the model faces severe headwinds. The very homes Opendoor holds in its inventory can quickly become depreciating assets, turning potential profits into significant losses. The company has made strategic pivots, aiming to become more of a platform that partners with real estate agents and offers a suite of services like title and mortgage, a move designed to create more capital-light, higher-margin streams. This is a logical evolution, but it also pits them more directly against entrenched players like Zillow and Redfin, who already have massive agent networks and consumer mindshare. For those with a Fidelity individual brokerage account or trading through SoFi stocks, the question is whether this pivot can happen fast enough to justify the current valuation. Looking at institutional activity provides another layer to this complex story. In recent months, there's been a notable increase in interest from hedge funds, with some, like Cube Research and Technologies, taking substantial new positions. This suggests that sophisticated investors see potential in the turnaround story. On the other hand, the stock has also attracted high-profile short sellers who are betting against the company's ability to navigate the treacherous housing market and achieve profitability. Analyst ratings are equally divided, with a consensus hold rating that masks a wide dispersion of opinions, from strong buys to outright sells. Price targets from different investment banks vary wildly, reflecting the profound uncertainty surrounding the company's future. This divergence of opinion underscores the high-risk, high-reward nature of Opendoor stock. It's not a stock for the faint of heart, but for those who believe in the disruptive potential of the iBuying model and the new leadership's ability to execute, it represents a compelling, if speculative, investment. Comment below with your thoughts. Do you believe the new CEO from Shopify has what it takes to make Opendoor profitable? The future outlook for Opendoor Technologies is a tale of two vastly different potential realities. In one scenario, the new leadership team successfully implements aggressive cost-cutting measures, streamlines operations, and accelerates the transition to a more diversified, platform-based business model. A stabilizing housing market, perhaps with a slight moderation in mortgage rates, would provide a crucial tailwind, allowing the core iBuying business to function more predictably. In this reality, Opendoor could finally achieve sustained profitability, and the stock price could continue its upward trajectory, rewarding the faith of its long-term backers and those using investment sites to build their portfolios. The other reality is far more sobering. The housing market could remain sluggish or even decline, squeezing Opendoor's already thin margins and leading to further inventory write-downs. The transition to a platform model could prove more difficult and expensive than anticipated, failing to generate meaningful high-margin revenue in the short term. In this scenario, the company would continue to burn through cash, and the recent enthusiasm for the stock could evaporate as quickly as it appeared, sending the share price back down to its previous lows. Investors in Fidelity ETFs and mutual funds with exposure to the real estate tech sector are watching these macroeconomic indicators closely. In conclusion, the narrative surrounding Opendoor Technologies is a classic battle between a compelling, futuristic vision and a harsh, unforgiving economic reality. The expectation, amplified by the stock's recent spectacular run and the installation of a new highly regarded CEO, is that of a company on the cusp of a major turnaround, poised to finally unlock the massive potential of the iBuying market. The reality is that Opendoor is a company walking a financial tightrope in one of the most cyclical and unpredictable sectors of the economy. The path to profitability is narrow and fraught with risk. Today's intraday decline, even after such a strong run, serves as a potent reminder that market sentiment can shift in an instant. The story of Opendoor is not just about technology or algorithms. It's about navigating interest rates, consumer confidence, and the immense operational complexity of buying and selling thousands of unique assets. The expectation is disruption. The reality is a high-stakes execution challenge where the margin for error is virtually non-existent. Whether you're trading on Robinhood, SoFi, or managing a sophisticated portfolio with Interactive Brokers or Fidelity, understanding this chasm between the story and the balance sheet is paramount.